Ira Koyner here, the original IRA and president of Triathlon Partners. Thanks for tuning into this episode of Triathlon TV, where we will be continuing our short video series based on our wealth building workshop of how to bridge the gap from your current financial situation to attaining your financial goals. Now, this is the second episode in the series. We're going to be talking about diversification, and most importantly, how we view diversification. Now, I have some slides here, which will help us expedite as well as hopefully add to the video. Let me share them. Now, diversification is something long desired by everyone in the financial world in terms of your portfolio. Really, it means don't hold all your eggs in one basket. The premise is if you have plenty of different securities in your portfolio, then obviously the performance of one of those securities will have a smaller impact on the overall return. It's supposed to shield you from your portfolio going down, right? Which makes a lot of sense. It's pretty common sense, right? But I'm going to argue right now that that sort of thinking is a little bit old-fashioned, a little bit backdated, because that theory came around when people would own individual stocks. That was the only thing in their portfolio. So that's great. And it actually came up that 30 stocks was the exact number that minimized that volatility. But guess what? What do people have in their portfolios now? They don't have just individual stocks. They have ETFs and mutual funds. They have index funds. Indexes like the S&P 500 have 500 shares in them. So guess what? You are diversified if you have the S&P 500 or the NASDAQ or the Russell 2000, or if you have any one of the mutual funds out there that specializes in growth versus value or small caps or dividend paying or sector based. You see the list up there, and it even goes on with fixed income, of government, of agency, of high yield and junk, of international, emerging markets, commodities, right? So there are plenty of funds out there. By just holding one, you are diversified. So my question really is, when you have all these portfolios and all these advisors telling you you need to have diversification, and you have 20 or 30 different mutual funds or ETFs, well, you're probably invested in the wrong things, because you're already diversified. But we look at diversification differently at Triathlon Partners. It's not about how many lines or securities in the ETFs that you're holding, because we know in today's day and age, it's impossible not to be diversified. The question is, diversification came around to minimize the volatility of your portfolio to achieve consistent returns over time. Then we have to examine the assets, because most likely you have assets in your portfolio that actually have higher than average volatility, that actually produce lower than average returns. And the only reason they're in there is for the sake of diversification. Now, here you have, you could see I have a whole big table of historical returns of asset classes, right? It's a little bit small, so I've made a nice little chart table on the side, which has the asset class, the annual return, and this annual return is cumulative return, and the annual volatility or standard deviation. So if we look at the top four things here, they're all stocks, right? We look, oh, well, U.S. large cap stocks have the highest annual return, and this is over 30 years. And then when you look at volatility, they have the lowest volatility, right? So from that standpoint, well, you got emerging stocks here, smaller return, much higher volatility. International developed, much lower return and higher volatility. And the U.S. small cap, a little bit smaller return and some more volatility. So the bottom line is, what are all these different holdings actually doing for you, right? And we see the same thing with bonds. You have all U.S. bonds, high yield bonds, international bonds. But look at that standard deviation on high yield bonds. It's pretty high. And you got cash. It's not earning anything. And people think gold. Well, look at the annual return on gold for the last 30 years and look at its volatility. The same with REITs. REITs are like half fixed income, half equities. They earn less than equities, but their volatility is higher. So these are things that we all have to be aware of, because our approach to diversification is to lessen the volatility of your portfolio without sacrificing returns, right? So that means we really have to examine our holdings because excess volatility will result in a delay of achieving your goals. You've worked all your life. You have retirement set for 2 years, 2 years time frame. You are in the finish line of that marathon, right? And what happens? The market tanks 20%. Guess what's going to happen? You're going to have to work more years. That's a big punch in the gut, right? So we want to avoid that. We want to avoid asset classes with high volatilities with below average returns and asset classes with low returns and high volatilities, right? They need to be re-examined. So we want to take advantage of products that minimize volatilities in higher returning assets. It might sound too good to be true, but it is a fact that can be done, right? How do we do that? Well, there's this neat investment product, this structure called point to point, right? Basically, it measures the performance of an asset from day one to day 365. And at the end of that year, it says this is the performance. And what does it do with the performance? It could be negative, it could be positive. But these point-to-point investments have something called protection. So those protections limit the losses. Some protections are at zero. Some protect, meaning you can't lose any money. Some of them, the first 10% loss is eaten by the product, and you're only on the hook for when it loses more than 10%. And in return, there is a cap, right? And that cap, all right, certainly they're high enough and to be content with earning every year. So this is something that we look for because when you can eliminate negative years and minimize the number of negative years, you're going to do much better off, right? So that's it for the point-to-point strategy. We're going to get into the next video on specific instances and actually quantify how much that volatility goes down and how little return you actually sacrifice. Okay, thank you very much for tuning in. I hope you really enjoyed this. It was our audiences at our workshop loved it. They just thought it was an awesome educational tool that they did not know about. So if you do have any questions, please contact us and we will fill you in with the whole education process on diversification, the triathlon way. Take care.